That is 6 straight cuts from the Bank of Canada in a row. After nearly 2 years of higher interest rates, we've seen the Bank of Canada cut rates from the overnight rate of 5% down to 3% in just the matter of 6 months. From that first rate drop back in July to a couple of mega cuts at the end of 2024, the BoC has opted to continue its rate cutting cycle just as it announces the end of quantitative tightening in the marketplace. What does that mean for you as a borrower? What does that mean for you as a potential homeowner? What does that mean for the marketplace? And how do tariffs actually have an impact on all of this? I'm going to try to answer most of those questions, or at least some of them today, right on the fly, as we've heard this news coming right out of Tiff Macklem's mouth, who is making the big decisions for the BoC. Now, stay tuned to the end of the video because I'm going to talk about projections and what this could mean again for the real estate market. Well, obviously the big news today is that the BoC itself cut rates right at a time when inflation is starting to hover around its overnight target of 2%. Now, the fact that they cut rates to 3% wasn't surprising. The market itself was basically saying that it was going to have a 75% chance of cutting rates for the last few weeks, even though there was a little bit of a bump in the ride back a couple of weeks ago. Also, what's interesting to note is just a few days before the announcement, the market started to tip and push over. And you could argue that some of that had to do with what's happening globally speaking with the quote unquote AI revolution out of China. But the reality is the BoC had no choice. They had to cut rates and they really did have to put themselves in this situation. Now, the key thing right here is lower rates, typically speaking, mean lower borrowing costs. But even sitting at 3% today, our overnight rate is still over 2% above where it was when we started this rate cutting cycle. So that means that most Canadians not only have or have had to adapt themselves to a changing rate environment, they're going to have to get used to a higher rate cycle for the time being. Unless something dramatic happens, which obviously could, knowing the Trump tariffs are coming up, it's not likely that we're going to see any other extreme drops in this current rate cycle, barring anything really, really big from happening. Now, the one thing that seems to be clear from the market's perspective is that barring any unforeseen events, we could see the overnight rate drop to as little as 2.5% sometime this year. And the markets are pushing for a relatively high chance of that happening by December as of just a few days ago. A lot of Tiff Macklem's presentation on the morning of January 29th was questions pertaining to Trump's tariffs and wildcard. And by no means were they dodging the issue, but there were a lot of questions around what this could mean. Of course, they are bracing for that worst case scenario, and he didn't hide away from a lot of the questions in regards to what could potentially happen, but there was no certainty given to what the real outcome would be. For more on that, we're going to go into a deeper dive in the next podcast episode, which will be coming out in the next couple of days. Now, the one thing about everything that happened today and all the announcements is that the trade tariffs are still continuing to be a massive wild card. The suggestion is that these tariffs could knock off 2.5 from our GDP. This is a significant amount, particularly if they go ahead with the 25% tariffs that they were talking about. And again, the economy is bracing for the worst case scenario, with Tiff suggesting that they've gone out and collected data and been requesting information from multiple different types of business owners and so forth to see what that impact would be in the marketplace. It sounds to me like he's also suggesting that we're also going to see a retaliation potentially in the marketplace, but that's not Tiff's choice or the Bank of Canada. That's more of an elected official consideration. So back to the matter at hand. The variable rate discount today means that prime is now sitting at 5.2%, which is great news for anybody that's holding a variable rate mortgage and potentially for those who bet on variable rates in the last few months. See, some of those people that were taking variable rates back in the fall of 2024 and even in the summer 2024 were sitting at least 0.75 to 1% with hopes that the Bank of Canada would cut rates over the course of the next 3 to 4 months. And it turns out that's happened because it looks like most fixed rates right now, when you look at a 5-year fixed and a 5-year variable, are actually sitting basically at par, which is the first time that's happened in over 2.5 years. And data from some of the major banks suggests that over 3 out of 4 borrowers are choosing variable rate mortgages for their insured mortgages right now. Now, the reason that they're talking about insured mortgages is because, as you might know, there's much bigger discounts on interest rates when someone is getting CMHC financing than if they're getting an uninsured mortgage rate. The rate premiums were as good as prime -1, prime -1.05, and even as high as prime -1.15 for people with less than 20% down mortgages in the last couple of months. And those who are doing uninsured mortgages, we're seeing prime -75 to 85. Those have been cut back significantly, and now we're seeing ranges of prime -45 to prime -65 on a regular basis. I did an entire episode about why variable rate discounts are going away, but you can anticipate with rates continuing to come down, if you're going to go with a variable rate, you could see more discounts start to go away, which doesn't mean that the variable rates are going up, but the discounts are, which means in effect, you're paying more money for a variable rate if you keep waiting. Now, what's next? We already talked about it briefly in the beginning. The BoC is suggesting that we could continue to see rates come down, although they would not commit and provide forward guidance in the marketplace, which is basically the fact they're not willing to give us any predictions in this current market and essentially letting the market decide what rates are going to happen. So Tiff is basically elected not to tell us what will happen in the near future, but basically said you can figure it out. The one piece of feedback that I would provide for a potential variable rate holder is to test your budget both in the high and the low end. Even though variable rates right now are looking really enticing, and I think there's a great case to be said for people who are looking for flexibility when it comes to mortgage rates and the potential of an opportunity if you are concerned about the downside risk, you do need to be cautious about the potential of rates not going down as much as you're hoping or the potential rebound. Now, there wasn't much talk specifically of a rebound happening, and I think most are not really in the place right now where they'll talk about rates going up, especially as they're on their way back down right now. But there is a precedent to say that rates could rebound for a variety of reasons the next couple of years if things go haywire. So you should protect yourself and make sure if you're going variable that you could make the payments if rates were to go back up if you took an adjustable rate mortgage. Which reminds me of the point, if you're in a fixed payment mortgage right now, you're probably not noticing any difference to your payments, but you will notice a difference in the amount of principal being paid, and you're probably back down below your trigger point now, which means you're most likely not going to be accumulating interest, but ideally paying off at least a small portion of the mortgage payment. Now, for home buyers, the continued trend towards people coming back to the market has already been seen. Anecdotally speaking, on my side, we've seen about 2x the amount of applications that we saw in just the fall of last year when things were picking up, and about 4x the amount of applications for pre-approvals and different types of mortgages from this time last year. The marketplace has been reacting in different cities, but not all cities across the country. We've seen talks of multiple offers. We've had more people out shopping, and we've certainly seen an uptick in the amount of optimism in the marketplace. And we haven't even seen spring yet. We're still in January 2025. So buckle up your seatbelts. With rates going down, you'll probably see more of those people who were sitting on the sideline make the decision to jump back into the marketplace today. For those who are holding off on buying and thinking that they're going to wait for rates to continue back down, probably not the best decision if you're waiting for costs to go down. Most of the marketplace is suggesting that variable rates could go down another 0.25%, but with the increase in buyer demand, much of the real estate market will find its bottom in most areas of the country. Now, that's not going to be said for all properties because, again, you're probably dealing with some of those outliers like the mass amount of condos and studios, but there is going to be a bottom. And for most people, they're suggesting that we have hit the bottom. So waiting for lower rates right now could basically almost do the opposite, where you're waiting for rates to come back down, but it ends up costing you more money because you have to qualify for a bigger mortgage. So that cost benefit probably wouldn't be worth it for most people across the country, but you should assess that on a one-by-one situation, even reaching out to our team where we provide an analysis of your current budget and timing. The interesting window right now is for those who are real estate investors. We've seen the rate market come back down. We have seen the market pick back up, but not extremely from a buying perspective. I think this continues to afford real estate investors a little bit more softening in the marketplace and more opportunities to try and pick up different types of real estate, because not all areas of the country are picking up or have picked up, and you still do have a period of time right now before the real spring market starts to hit. The one thing to be conscious of if you are in the rental market right now or buying real estate from a rentals perspective is to watch out for rental demand. We've seen the decline since 2024, and that could continue to decline as immigrations come back down. So although that market itself could rebound in the next couple of years and rental rates long-term will go back up, you need to be cautious and careful about analyzing your numbers and looking at the potential of rental rates to go down depending on where you're purchasing the real estate. So what's next and what's the wild card? Well, what's next is the next Bank of Canada update is in March of 2025, and a lot could happen between here and there. With Trump's tariffs on the table for February 1st, just a few days away, and the possibility of a lot happening between now, then, and March, there are so many wildcards that I don't think anybody is willing to make some massive predictions about what's happening or going to happen in March. Now, the markets were suggesting that we do not see a rate drop in March, but we wait to see one in April. And I think that really just comes down completely to what happens in the marketplace from a tariff perspective. So again, if you're waiting for rates to come back down, the chances are still strong that we see them come down 1/4 to 0.5%, but it's very probable that we don't see anything happen in the March timeline. What we're going to be looking out for is the Trump tariffs as the next big levy to break. And I do think a lot of people in the real estate market or who are sitting on the real estate market were waiting for this ball to drop and the next ball to drop as it relates to the Trump tariffs. I did a complete video already exactly on all these details. So if you're missing any of this information, go ahead and hit the YouTube channel, subscribe to that, subscribe to the podcast so you can get all this information right to you. Now, last but not least, if you're someone who's in the marketplace trying to figure out what to do, my suggestion to you is to reach out to us so we can actually ask you the 3 key questions to help you understand if it makes any sense to buy today or wait until the time is right for you to get back into the marketplace. As always, if you like this information, make sure to subscribe to the YouTube channel below, and we'll see you on the next one.